Let me know if this sounds familiar. You're going to file your taxes at the end of the year, and your tax accountant asks you for your balance sheet, and you immediately defend it with the phrase, "But I don't know if this is right or not." Right? Guess what? You are not alone in that. You started a business because you were passionate about something and you knew you could earn some money doing this thing that you love. What you probably didn't do is take time out of your day to go to business classes to learn how to do accounting, keep a balance sheet, and know what that actually means. So today we are going to chat about the 4 common biggest mistakes you can make on your balance sheet and how you can quickly catch these mistakes in your own QuickBooks file. But if you are new here, welcome to our channel. My name is Katrina. My business partner Cheryl and I own and run Empower to Profit, where we help business owners just like you put more of your business revenue into your personal pocket. Because if you're not making any money doing what you're doing, then what's the purpose of even doing it, right? So let's go ahead, let's jump right in, and let's explore the balance sheet. So before we start looking at some examples, let's start out talking about what the balance sheet actually is and what it means in real life when you're looking and thinking about your business. So the balance sheet is just a financial statement that tracks your company's progress. It's broken down into 3 main parts: your assets, your liability, and your equity. Your assets are what you own. Your liabilities are what you owe, and then your equity is the money left over after the expenses. The balance sheet is like a financial snapshot of your business at a specific moment in time. It's called the balance sheet because it follows the accounting equation. Your assets are equal to your liabilities plus your equity. So it's easiest to think of it like a seesaw, and the equation must always stay in balance, right? It keeps everything in check. If you change one side, you have to change the other to make sure everything stays proportioned. Let's hop right into these 4 most common mistakes we see with business owners. So, number 1, you are forgetting to add transactions or data to your QuickBooks file. Seems really simple, but we see it all the time. As a business owner, you are wearing a ton of hats and doing a lot of business in different areas day to day. So you can do something and forget about it almost immediately, and that transaction or the information or data never gets put into the QuickBooks file. For example, when a piece of equipment is purchased, the loan has to be added as a liability, and then the piece of equipment or whatever you purchased has to be added to the balance sheet or to QuickBooks as an asset. A lot of people don't think about that, and even more don't know about it. Another popular one is petty cash. A lot of business owners think because the money isn't necessarily going through the bank that it doesn't have to be recorded, but it does. Another big one is inventory. A lot of times business owners can forget to record whether they're selling inventory or purchasing inventory. So a really easy, quick tip to fix this is to create a reminder, whether you're a phone reminder person, an alert, a write on a calendar, a sticky note reminder. We recommend to all of our students that you are checking at least monthly to be sure all of these transactions have been added to your QuickBooks, because it's a lot easier to look back a couple weeks and say, have I purchased anything big? Do I have any cash on hand that hasn't been recorded how I got it or how I deposited it? It's a lot easier to look back in a short amount of window and catch those things and add them at that moment than to go back a year later and try and remember everything that now you don't have recorded down in your QuickBooks file. Mistake number 2 that we see a lot of is simply recording information incorrectly or wrong. It's very easy to reverse numbers when you're collecting a lot of data, especially when it comes down to numbers or if you're dealing with thousands of dollars. A lot of times numbers can get reversed or mistaken. Something that should have been an 8 is put in as a 6 because it was hard to read on a receipt or something like that. There can be like a transfer error when you're copying data from one source to another. It can get transferred incorrectly. And the easiest tip we have for that is to reconcile monthly. That way you're going through all of your accounts, and if something isn't reconciling correctly, you'll be able to see it immediately and address it quickly, easily, and efficiently. So, item number 3, liabilities. Let's chat about what this means for a second. So, liabilities are something that you own to somebody else. I like to think of it as liabilities equal loan. I owe somebody money. My business owes somebody money. So, liabilities in real life examples can look like sales tax, accounts payable, meaning bills that you have to pay somebody else. And a lot that adds to this confusion is that a lot of time liability accounts, things are paid into it and then payments are made out of it. So there can be quite a few transactions in a liability account that can get a little confusing to business owners, and rightfully so. There's a lot going on here. But if we break it down and look at it, it really makes sense on what's happening in that account. So, like we said, a liability account is something that you owe to somebody else. A big one that we see when it comes to liability accounts is a sales tax liability account. So, I wanted to show you where you would be able to find that in QuickBooks. So you can go ahead and check your own file to make sure things are being recorded correctly. So this is the screen that you should be looking at. I'm working in a sample company, so I can show you guys what it will look like. But if you go to this business overview and then you click into reports, you're going to pull up your balance sheet report. And in that, you will see the liabilities listed here. And then if you scroll down, so this account's payable, that's what we are talking about. These are bills that you owe to be paid to somebody else. This is like a credit card that you have to pay. And this right here is what I was talking about. This is where your sales tax is recorded. So when you're looking at this account, let's say you sell a product and you collect sales tax on that. When you collect that sales tax, that tax amount should dump into this account here. And that's a mapping issue. And if it's not being dumped, leave a comment below or reach out and we can look into the mapping of your QuickBooks file for you and get that fixed up as well. But let's just say everything is set up correctly. When you receive payment for the product, the sales tax is dumped here. So you will see this account grow. With every payment that you receive that you collected sales tax on, it should add to this account here. Now, when you make a payment, so typically you pay sales tax on a monthly basis. Sometimes it's quarterly, sometimes it's annually. But for the purpose of this example, let's just say you're paying monthly sales tax to your state. In this example, it's the state of Arizona. So like we talked about, every payment that a customer pays you, the sales tax gets dumped into this account. And then when you make a sales tax payment to the state, you'll see the account reduced. So for this example, this transaction includes 2 payments. So 2 sales happened. The first one, we had $29.96 worth of sales tax. The next transaction, sales tax was $8.44. And then at the end of the month, we went ahead and did our sales tax payment, recorded it in QuickBooks, and we paid that $38.40. So that account is reduced by that, and you have a $0 balance. That $0 balance is what we are shooting for. You may not always reconcile to 0, but that's the goal. So you can see here, these transactions go from January to current day. So this might be a little bit different in your books. If you sell products, a lot of products, you're going to have a lot more transactions. So everybody's might look a little bit different depending on your business. But this is the simplified version of what's happening here. So, the tip that I have for you here, or a solution when you're looking at your liabilities, is you're going to want to check this again, at least monthly, to be sure this account is staying low. If your liability account is negative, then that's a red flag. Something is off. It might be negative for, a small portion of time, a couple days or a week until your payments all balance out. But if this account is negative, that means you are paying more than what is being owed, or it's not being recorded correctly. Like we chatted about, it could be a mapping issue. It could be that you have too many liability accounts set up in your chart of accounts. And again, this could look different for everybody's books, but if you are seeing this as a negative, then that is a huge red flag. You're going to want to dig into this register and kind of find out where things went crazy. And again, if you need help doing this, I'll be more than happy to make another video to explain things, or even hop on a free call and we can chit chat about your book specifically. So the fourth most common mistake we see with our students is recording loans and assets when vehicles are purchased or a big piece of equipment is purchased that you are making loan payments on, something like that. So I wanted to walk through the best way that we think is the cleanest, the easiest way to record both the loan and the asset, so both can get added to your balance sheet. So the first thing you're going to do is you're going to want to pull up a journal entry. So to do that, you're going to go to this plus new, and you are going to click on journal entry. And you're going to want to pick the date of your journal entry to be the same date as your vehicle purchase or whatever you purchased. And then in that first line, so first we're going to record the liability. So this would be the loan. So remember, liability is something that you owe to somebody. Liability equals loan. I owe somebody money. So I had to get a loan. I'm going to be making monthly car payments for this new vehicle, this new truck that I have for the business. So we have to add that new loan as a liability. So you're going to go to long-term liabilities, notes payable, and this is for the 2023 Ford truck loan. Maybe I'm going to say this is the red truck. All right, you don't need to worry about any of this. You're going to save and close that. The next thing we're going to do is record the asset. So we're going to record the actual value of this Ford truck onto your books because it is now an asset to your business. So you're going to click on line 2. You're going to go to add new. You're going to fixed asset. At the bottom, there should be a vehicle. And again, you can hit red truck. You're not going to fill in any of this. This is QuickBooks trying to help you, but we're not going to do that part. And let's say this loan is $25,000. So you are going to, in the credit, the loan was for 25. Well, let's just do $10,000. So the vehicle is worth $10,000. I got a loan for $10,000, and I'm going to use 8/1 as my purchase date. I'm going to save that. Now go to my chart of accounts and refresh my screen. And you'll see it in both your chart of accounts as a asset and as a loan. So now if we go to reports on your balance sheet, and make sure you select the date. So remember, we purchased this on 8/1. So if we stopped this back in July, the vehicle wouldn't come up yet because as of this date, we had not purchased it yet. So let's do 8/1. And then if you scroll down under assets, you will see the vehicle listed here. If you scroll down under liabilities, you will see the Ford truck loan here. So you have the loan recorded and both the value of the vehicle recorded here. One last step that I want to include in this is if and when you are making a vehicle payment. So let's say now I've had the vehicle for a little bit. It is time for my monthly payment to come out. How do I record that payment, right? So for the purpose of this example, I want to really make sure you guys grasp this because it's important and it will help reduce your tax bill at the end of the year to make sure you're claiming all of your expenses. So let's go ahead and pretend this 8/9 is your first truck payment on the loan. So again, we want to reduce the loan by this much because we are making a payment to the loan. But remember, there are typically interest amounts included in a loan payment. So for this example, let's say your payment for the loan is $1,180 and $20 is interest. What you're going to do is go to split this expense and you're going to pick the liability account because remember, we are reducing the loan. So this Ford truck loan, we're reducing it by the payment. And we're reducing that by $1,180 because $20 of that is an interest payment and it's not reducing the loan, it's a interest expense. So, and then, so I see your $20 here. We are going to add that as an interest. Now, I like to record interest per loan. It's what I like our students to do as well, because a lot of times at the end of the year, your tax accountant is going to ask you what were your interest paid amounts. And it's just easier if we break them out by loan because it just keeps everything cleaner. It's easier to reconcile. It's easier to find mistakes or something that was missed. So I like to do it as a subcategory of this interest paid. So I'm going to go to add new. This is going to be an expense for interest paid. I'm going to put this as my 2023 loan interest paid. This is going to be a sub-account of that interest paid. And then you're going to save and close that. So when we go to add our $20, we want to make sure that's going to this loan for the 2023 Ford truck loan. And the interest paid. And that's going to be the $20. And you're going to apply and accept that. And you can see how it's broken out now. There's no difference. So everything is clean. Everything reconciles. You apply and accept that. Now, when we go back to the balance sheet, again, you're going to want to make sure the date correlates with the date of the expense to make sure it was recorded. So we're going to check the loan to make sure the loan was reduced by that $1,180 payment we made. And you can see here, so the starting balance of the $10,000 loan, and then it's reduced by that $1,180 payment. And then the interest is going to be recorded on your P&L or your income statement because it is a tax deduction that you can claim for your taxes to reduce your tax bill at the end of the year. So you're going to go down to interest paid, and there you'll find that $20 that you'll be able to claim on your taxes. So that pretty much wraps up the 4 most common mistakes we see on a balance sheet. The overall tip for you guys is really to look at your balance sheet at least on the monthly basis. That way you'll be familiar with it and you will be able to spot any red flags, any big identifiers where something is off. Again, if you're seeing any negatives in that liability account, something is up, especially if it's a big number. If there's something on the assets list that you don't know how that got there, it's an amount that you're not familiar with, something is off there. Remember, when you are making a big purchase that you have a loan on that you have to make a payment to, make sure you are recording the loan and the amount of the asset. That way both make it to the balance sheet. And please don't forget to record the interest from those loan payments because that is a tax write-off for you, which will reduce your tax bill. So that wraps it up. I hope that was helpful. If you guys have any questions about balance sheet, red flags, anything weird, I would love to take a look for it. But that's all I have for you today. So as always, cheers to profit.